All right, everyone. Sorry, today I don't have my camera on, but I will be going through the suburb of Campbellfield today just to assess its viability and whether it's worth investing in 2025 into Campbellfield. Before we get into the data side of things, I'm just going to touch base on the geography. So yeah, it's really close to Dallas. You're probably only 15 minutes, 20 minutes away max from the airport, 25, 30 minutes to the city. There's parks, there's shops, there's everything. So I mean that's a good starting point, close to arterial roads, etc. Now, what I would say though is, if we look at the geography of Campbellfield, if you can see where my mouse is right now, very large portions or very large sections of Campbellfield are industrial, retail, factories, etc. So you really don't have too many pockets to play with. Another thing to sort of consider, so you've got maybe this residential pocket here, which is up towards Dallas, and then you've got this one that sort of backs onto this little reserve here, but I do know that planes do fly over there, so please be careful. And then you've got a really small pocket of homes down here near the shops, etc. So there isn't really too much to pick from, but there's a lot of infrastructure spend going into these areas, so yeah, we do expect it to sort of improve over time. Again, planes fly over these areas, so check for overlays, check that you can actually subdivide the property. There, much like Dallas, there are a lot of things that you sort of have to look out for. So let's just jump into the data for Campbellfield now. Let's have a look. All right, so let's get through the data. Campbellfield already moving in the positive direction. That's a good sign. Rental returns are strengthening and going up, so that's good. So you get better yields over time. Let's have a look. So we've got infrastructure spend through the roof, so a lot of money being spent in this area, which is a good sign as well. Over a long time frame, if we look at the price, it's been going up, but it's been a bit of a bumpy ride. A few negative growth cycles here and here. So, I mean, this could be an example of what's to come. You'd still get some growth, but maybe expect a little bit of volatility moving forward. All right. Okay, let's keep looking. Relatively low socio, like I said, similar to Dallas, the review that we did yesterday. So I mean, not amazing. I do expect it to grow. I mean, just as a general rule, we like to say, if we've got a standardized value of ISRAD score of 1 or 2, we wouldn't expect it to keep pumping beyond the 750 mark without some pretty significant negative retractions over the year. So just keep that in mind. It's still going to grow over the short term, much like Dallas. 26% renters, which is a healthy amount, not too much, which is that's good. All of the supply metrics are very ideal right now. You've got long hold periods, you've got low building approvals, you've got low stock on market, you've got low inventory. So all of that's fantastic. And we can see the relationship or the trend is on the downwards trend. That's what you want to be seeing. Okay, awesome. And yeah, look, over time, a bit volatile, but it is trending in the upwards direction, the amount of time people hold on to their homes, so that's okay. The demand, I mean, hasn't really intensified yet, but it is 27 days, which is still quite a competitive market. You've got a vacancy rate of 0.59, which is very, very tight, so that's probably why we're looking and seeing those rental growth figures. We're also seeing the trend in the vacancy rate on the downwards direction, which is exactly what you want to be seeing. So it's tightening. Any of these sort of peaks and troughs, I wouldn't worry about. Just look at the overall trend. And obviously, a vacancy rate of 0.4, what was it, 0.49%, or 0.59% is extremely tight. So it's fantastic. Okay. Yeah. So just to sort of summarize, it's very, very, it's positioned very, very well for some short-term growth. We could see things, like I said, over the coming years after the huge growth wave that's about to hit it. We could see a bit of negative retraction, but all areas go through this, so there's no concern there. Now, affordability, again, it's no surprise with ISRAD score or low socioeconomic status in the area that the houses for the local population are going to be unaffordable. Yeah, and look, there's many areas in Melbourne that will grow, that have low socio populations, that have very unaffordable houses for that local population. like I said, much like Dallas, it will grow in the short term, but it just will be a little bit more of a bumpy ride compared to some higher socio areas. Like just to sort of visualize it, we're looking here at this little graph here. It's going up over time, but you've got some pretty strong growth periods and then a pretty extended period of time of negative growth. So from, let's say, 2018 to about 2020, just 2 years of negative growth. Nothing significant, but enough to eat away at some of the gains that you've had. So again, overall, you don't have many pockets to choose from, but this area is not a bad area to invest in if your focus is short-term growth. Thank you very much for watching, and please let me know if you have any other questions or any other suburb requests.